This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, July 29th at 8:30 Mountain Time. Our note this week was titled The Recalibration Cycle. You're either watching the video on YouTube or listening to the introductory version of our weekly audio summary, which goes through our note. And that note is our marquee product this week, in addition to the note that we released off schedule this morning. Typically we release on Saturday mornings. We're also going to put out a note on Wednesday, which will be a preview of Friday's crucial employment report, as well as providing some of our initial thoughts on the Treasury quarterly refunding announcement, if it's notable, if they change the issuance schedule, which is skewed towards bills and somewhat politically skewed towards bills, we suppose. And of course the FOMC meeting on Wednesday as well. Also notable, if you are a full paid subscriber to Ironsides Macro, we will live chat using the Substack apps about our initial thoughts during the FOMC meeting, and then on Friday during the employment report. So there's lots of value there. You're getting a product, institutional level product, for a pretty approachable price. So that's it from all of the housekeeping related items. As far as our note this week goes, this is going to be a big week. I mean, to state that is a little bit of almost of an understatement. We're going to get the JOLTS report on Tuesday, which will tell us a lot about jobs openings. Remember, this beverage curve has been a key model for the Fed in terms of thinking, and Waller in particular, Governor Waller in particular, in thinking about the relationship with unemployment and vacancies, and whether we have excess demand for labor or not. We're at a point where any further weakening demand would imply a nonlinear or really fast increase in the unemployment rate. Fed's clearly concerned about that. We get the employment cost index on Wednesday. We've had very little data on wage growth in the second quarter. We, of course, get the weekly or the monthly average hourly earnings series, but the Atlanta Fed, who had a very good series known as the wage tracker, hasn't reported all quarter due to problems with the quarterly census and employment and wages, and the question about how many jobs we're actually creating or not within the small business sector, which is a big deal. We're going to get more information about that later this month, which will go some ways towards determining just how aggressive this recalibration cycle is likely to be. We think it could start with a 50 basis point cut in September if that revision is as we expect it to be, which would show 1 million fewer jobs in the year ended March of 2024. We're also, of course, getting tech earnings, big tech earnings. We think they're going to be good. No big surprise there. We think it's too early to be concerned about ROI and the Gen AI investment boom, but expectations are high. We saw that from Google. So if markets are afraid, even good numbers might not be enough. And then, of course, we get the Bank of Japan meeting, quarterly refunding announcement, FOMC meeting. We had a lot of details in all the notes, but as I said, we won't get an explicit promise from Powell to do anything in September this week, but we do think they're headed towards a reasonably aggressive rate cutting cycle that'll get us to 4%. The market thinks by mid-year next year. We think it needs to come sooner than that to avoid some problems in the small business sector. So that was the gist of the public policy outlook. We then had a section on nominal growth and earnings. Last week's GDP number looks pretty questionable. Composition wasn't great. Service sector spending slowing. We think they made a mistake on CapEx, particularly for equipment. We got a Census Bureau durable goods report that came at the same time that was wildly divergent from what the BEA reported. Remember, these are different agencies. They do share data, but something went amiss there. And we think it'll likely be revised lower. And finally, the Fed should be concerned about the slowdown in residential investment. The housing activity numbers are really slowing, and we think that we're running a risk of a double dip in housing. So the Fed should definitely be starting that easing cycle as soon as this week. Former New York Fed President Dudley, a man we know pretty well, was urging that, and we think he's correct on that front. They won't do it, but nonetheless, that could mean that they wind up starting with a 50 in September. We wrapped it up with some thoughts on correlation, volatility. At the end of all this data this week, there is a chance we go back to higher for longer island, as some call it, with the back end of the treasury market under pressure and tech leading a fairly narrow equity market advance. But more likely, we think we're looking at a real deceleration of growth that will cause problems for the markets, like we saw last week through Wednesday, until that GDP calms some nerves for a time. But we do think growth is slowing here. The Fed is overly restrictive, and they ought to be getting started with the rate cutting cycle sooner rather than later. That's it for me this week. Barry Knapp from Ironsides. Have a good week, everyone. Thanks.